Bang! I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem on how to properly determine the effects on the financial statements. So if you're not familiar with the financial statements, don't fret, gang. I'll drop the link to get you up to speed in no time. With that being said, let's get it! So it tells us, in recording adjusting entries, Regan Financial Advisors fail to record the adjusted entries for the following situations. Alright, so we have 5 particular adjusted entries, of which the company failed to record. And then it says determine the effects on the income statement and the balance sheet by identifying whether assets, liabilities, equity, revenue, and expenses are either overstated or understated, and use the following table. Alright, gang. This one you're gonna really have to put your thinking caps on.
Write it down and keep it for future reference.
If you feel a need to kind of fine-tune your understanding of adjusted entries, just check out the link I provided right there and go from there. So, here's the deal, gang. We understand that adjusted entries are important because it properly adjusts certain accounts, either decreasing them or putting them on the books right before we make the financial statements. Therefore, if we didn't do the adjusting process, certain accounts on the financial statements will be overstated or understated, higher than what it should be or lower than what it should be. Now, in this particular exercise, we're going to determine how does not recording proper adjusted entries affect the balance sheet, which consists of assets, liabilities, and equity, and the income statement, which consists of revenues and expenses. Now, there's a connection between the balance sheet and the income statement, gang, that we must first adhere to. Income creates retained earnings. It affects retained earnings because we know that retained earnings is a stockholder's equity account that belongs on the balance sheet, of which is affected by income. When we have net income, meaning our revenues are higher than our expenses, it increases our retained earnings balance. However, when we have net losses, the expenses exceeding our revenues, it will decrease our retained earnings balance. So what am I saying? Whatever's affected on the income statement will affect retained earnings as well. And that's how the income statement and the balance sheet is connected, through the retained earnings account, gang. Let's look at these problems. The very first one tells us that office supplies is on hand for $100. What do we have to understand about office supplies? Office supplies, in terms of adjusting supplies, is treated just like a prepaid. How is that? Well, we know what prepaid expenses are. Supplies aren't considered prepaid expenses. However, when it's time to adjust supplies, when we use up supplies, our recordings are the same. What do I mean? Well, we know from previous videos, gang, when it's time to record a prepaid and adjust it, the expense happens and we have to simultaneously lower that prepaid, meaning that we're going to debit the expense, credit an asset. Same rule applies with supplies, gang. Supplies is considered a short-term asset that the company uses. However, as the company uses up the supplies, we have to make a proper recording. That proper recording will consist of a debit to supplies expense and a credit to supplies. And so with that being said, if we fail to record the proper debit to supplies expense and credit to supplies, how would that affect our financial statements, particularly the balance sheet and the income statement? Well, let's identify the balance sheet. The balance sheet consists of assets, right? So if we fail to record a credit of supplies, gang, that basically means that we are failing to lower our proper asset accounts, which means on the balance sheet, our assets will be overstated. And as we can see, that's the correct answer. Now, what about supplies expense? If we fail to record that supplies expense, we fail to debit that supplies expense, that means that we didn't actually record an expense on the books. If we don't have an expense on the books that should be there, that means our expenses are understated. And how would understated expenses affect the income statement? It would affect the income statement by making the income overstated. What about equity? Well, if our income is overstated, meaning that our expenses are higher than what they should be, then our retained earnings account, which is simply income, will also be overstated. And that's why our equity account is overstated, gang. Let's move on. Next, accrued revenues are $5,000. Gang, we already understand that accrued revenues are simply revenues that have been earned, but they haven't been received. Thus, the proper adjustment entry requires us to debit accounts receivable and credit service revenue. So how does that affect the financial statements? If we fail to increase our accounts receivable, which happens to be an asset, that basically means that our assets are being reported lower than what they should be, which means our assets are understated. What about service revenue? If we fail to record service revenue or increase service revenue, that means that our revenues on our income statement are going to be lower than what it should be, making our income lower than what it should be. So our revenues will be understated as well, causing our stockholders' equity, particularly retained earnings. Remember, gang, retained earnings is income. So if income is lower than what it should be, our retained earnings should be lower than what it should be as well. So our retained earnings account will be understated. No effects on liabilities with this problem because it's not affected. Moving on. Next, it tells us that accrued interest expense of $250. Gang, an accrued expense, we know by definition, is an expense that has happened, but it hasn't been paid for, which means that the proper recording for that requires us to debit an expense and credit a payable, particularly interest. So, if we fail to debit interest expense, meaning that we fail to increase interest expense and increase our interest payable, how does that affect the financial statements? Well, in terms of interest payable, the last name being a payable, that makes that a liability. Our assets aren't affected in this problem, but our liabilities are. Now, we failed to increase the liability, which means that our liabilities on the balance sheet is going to be lower than what it should be, meaning that our liabilities are going to be understated. What else happened, gang? We're talking about an accrued expense, which means that we failed to record an expense, an interest expense. Since we failed to increase our expense on the books, on the income statement, our expenses are going to be lower than what they should be, meaning they're going to be understated. Since our expenses are lower than what it should be, our income is going to be higher than what it should be. And since our income is higher than what it should be, our retained earnings will be higher than what it should be as well, meaning that our retained earnings are going to be overstated. Let's move on. Depreciation. This one is a tricky one, gang, so bear with me. We know the proper journal entry for depreciation requires us to debit a depreciation expense and credit accumulated depreciation. So from that being said, we understand that our depreciation expense belongs on the income statement. If we fail to record that expense, our expenses are going to be lower than what they should be. So let's go ahead and mark that. Our expenses are going to be understated. Since our expenses are going to be understated, that would affect our income. That's going to make our income higher than what it should be, which will make our retained earnings higher than what it should be. So therefore, our retained earnings will be overstated. Now, what about accumulated depreciation? Well, accumulated depreciation is a contra account, gang, and the purpose of that accumulated depreciation is described in its name. It accumulates, it collects the various depreciation that we make throughout the period. And that depreciation lowers the value of our asset on the balance sheet. Accumulated depreciation is subtracted from the cost of the asset on the balance sheet, which gives us the book value. So, how does that in turn affect our assets? If we fail to record a depreciation gain, simply put, our assets are going to sit on the balance sheet higher than what it should be. So our assets are going to be overstated. And last but not least, unearned revenue that has been earned, $550. So whenever we record the adjusted entry for unearned revenue, we have to lower the liability and record the actual revenue that's been earned. Remember, gang, unearned revenues are created whenever we receive cash in advance for a service to be provided in the future. The moment that that service is provided, that liability, us owing the service, is no longer in existence, which means we have to lower the liability by debiting the unearned revenue while simultaneously creating the new revenue that was earned by crediting that particular service revenue. So if we fail to debit unearned revenue and credit service revenue, how would that affect the financials? Well, obviously from the income statement approach, we know that our income, our revenues are going to be lower than what they should be. So that means they're going to be understated. So if our revenues are understated, lower than it should be, our equity should also be understated, particularly retained earnings gain. Now, what else happened with the proper adjustment for an unearned revenue? We must decrease the liability. We must debit the unearned revenue in itself. So if we fail to decrease that liability, our liabilities on the balance sheet is what? Higher than what it should be. You got it, gang. So that means our liabilities are going to be what? Overstated. No effects on the assets because it didn't happen. Nothing affected our assets with that one. So we're going to check all of these and cross our fingers. Bags all day. So there you have it, gang. This one was a doozy. I must admit, gotta keep it real. But hopefully it made sense to you. You may have to watch it a few times, but it'll definitely click. Scout's honor. With that being said, I'm Dr. Who, and I always appreciate your time. Don't forget to like, subscribe, and share the channel with your friends so they can chase the bags as well. And I'll see you soon. Bags!